All right, so let's begin the show by talking about AI. Artificial intelligence has been transforming various industries, and the financial services sector is no exception. With the rise of robo-advisors and other AI-powered financial tools, many are wondering if human financial advisors will soon become obsolete. Let's explore the pros and cons of AI-driven financial advices and assess whether AI is likely to replace your financial advisor anytime soon. So let's welcome on board Krithika Muthukrishnan, Chief Data Science Officer. Krithika, good evening and welcome to the show. So we've been seeing AI doing a lot of things, whether it's about doing kids' homework or helping people or professionals with important data crunching and number crunching. But then what's really important to consider over here is that will AI be your future financial advisor? So far, what is the kind of financial planning or the understanding of financial instruments AI is been offering people? What have you tested and what have you seen?
Good evening. Uh, so AI and particularly generative AI, ChatGPT and things like that have really, I think, taken the world by storm. It's been in the discussion a lot in the last few months. But one place where AI has been used quite often in financial services is investment selection. For example, we at Scriptbox have always believed in a algorithmic evidence-based approach to investing. And so what does that mean? There are about 40 asset management companies and more than 1,300 individual funds to choose from. And the sheer volume of options can be quite overwhelming for investors. Right? Not only that, when selecting a particular type or a specific fund, you need to consider different factors. Like what is the investment objective, what is the risk profile, what is the investment horizon, and so many more other things, right? And each element plays a crucial role in determining what's the right investment strategy for a particular investor. So what we do is by using a non-bias that is based on data and evidence, we help investors select the best funds for their needs. And your AI engine not only helps you shortlist the parameters that are most important, but assigns a weightage and then helps you understand which funds are the best, are your recommended funds, right? Making the entire process quite rule-based and objective. Now, while organizations like ours have been using this for some time, I think the emergence of AI is great from an investor perspective. What's going to happen is the industry is going to use more such algorithms and AI for fund analysis, and investors are going to get better and more objective advice. So this entire emergence of AI is great for the investor.
One little difference I want you to highlight, which is the difference between robo-advisory and AI suggesting you financial instrument and doing your financial planning. Both the same thing, or there's difference?
There is difference.
Okay.
So, like I talked about, robo-advisory really focuses on helping you select the right investment products and funds. So, objectivity is a big benefit of robo-advisory. AI lets you take it forward.
Robo-advisory also, but in robo-advisory also, Kritika, can we say that it is AI driven?
It is, I would say, it can be AI driven,
Okay.
but more
Okay.
importantly, it's algorithmic driven,
Acha.
and it will typically be tech driven, right?
Hmm.
More you can use AI, and more advanced organizations are starting to use AI there,
Mm-hmm. Okay.
right? Whereas what AI allows you to do is to actually do more than robo advisory. It allows you to take it forward to personalization.
Okay.
So let me just try and explain this a bit, right? So you have
Sure.
to understand each individual investor is different, right? So they're in different stages of life. So an investor in Indore who's 48 years old and say is going to put two kids into college in the next 5 years has a completely different set of goals, ability, and willingness to take risk from someone, say, who's sitting in Bangalore who's just 35 yet to have kids, right? So not only that, their emotional needs can also be quite different, right? So how do they react to market turmoil or changes in the market? So I think the next big thing for AI, which is emerging, is personalization, right? So personalize the experience for each investor. And basically, this is what we call hyper personalization, or recognizing the individual needs of each customer and delivering to a segment of one. So each person will get an individualized investment strategy, what products are right from them, and when and what kind of help do they need. Now, going back to your question in terms of how this will be delivered, now this may be delivered through an advisor who has these AI recommendations to help him deliver better advice to the customer, because there is that human touch that is needed. And a combination of these becomes really powerful.
Exactly.
Over
So
a
I
period.
was just coming back to that point because the human touch is important, and people in India, it's your hard-earned money that you're putting into. And for that, if you do it through an AI, might sound very complicated and also a trust factor that really matters a lot when you go for these kind of investments. But also, just adding to what you also mentioned earlier, now an AI will obviously configure everything and give you the best available options, analyzing and assessing your risk appetite, your long-term goals, and the kind of investment instruments you're comfortable with. But then, how do we know, or how can we ensure? For example, if we talk about stocks, if someone wants a recommendation in large cap stock category, how do we know that what's been suggested is actually accurate?
So you have to trust the process, right? So that's the first and foremost thing. And over a period of time, your entire AI technology gets better and better in terms of recognizing what are the parameters. So even in terms of when an individual advisor looks at it, he's following some kind of process to select a particular fund. AI just scales up that process and makes that process much more rigorous and much more fact and evidence based. So that's the benefit that AI brings. So, for example, there may be, I don't know, 100,000 research reports out there. It's literally impossible for one individual advisor or even a bunch of advisors to look at all of that and distill that out into what's meaningful for the investor. What AI can do is really help, analyze that information, tell you how do you rate it, and provide you recommendations along with why it's saying that, so an advisor can use that to better recommend things to his investor.
In a country where we are talking about financial literacy being the most important aspect of financial planning and helping people participate in the equity markets and basically the understanding towards financial planning and investment portfolio, do you think having an AI suggesting you all these things will help in the financial inclusion or financial literacy that we are aiming as a nation?
See, I think we need to take into mind that technology is changing very fast, right? So I think if you look back 15 years, the idea of people buying funds and stocks online without an advisor would have been very difficult to understand. But as the technology becomes better and better and more suitable for an individual use, for a customer use, I think you will start using it more and more. But that's not to say that the human advisor does not play a role. The human advisor plays a very important role in helping the investor with the emotional management, what we call emotional management, right? So helping him understand why we are saying what, making sure that investors don't panic, say when suddenly the market is low, just making sure that they have a place and a person to go to ask questions and get them answered. So it's a combination of human plus AI, human touch plus AI, that would be
I
really
wanted to
powerful going
understand
forward.
because this will clearly not nullify the role of a financial advisor, which people are thinking and really bragging about these days that, we are getting a financial planning done over an AI. So, as you rightly pointed out and highlighted also, behavioral finance and the kind of emotions an investor is attached with, when it comes to their investment strategy or portfolio, I think that is something that cannot be replaced through an AI. But then what's important over here is to understand the kind of help you should be taking from an AI when it comes to your financial planning or your investment instruments recommendations also, because right now what even I tried googling up a few AIs and trying them out. It gives you a very generic basket of investment instruments. If you, for example, just ask them that you want to have your 70% exposure in equity and the rest in debt, so it'll give you all kind of recommendations that's available. But then for you to understand what's right for you, you still might need a human financial advisor's help.
So it depends on what stage of investment you are and what kind of investor you are. So since you mentioned you tried different AI and algorithmic tools, I suggest you give Scripbox a try. But basically, you know, uh, I think it's more important that investors understand the investment process, right? So they need to have a clear goal. They need to understand what their financial objectives are. So is it about funding a child's education or planning for retirement? And then they need to stay invested, right? So it becomes really disheartening for us, for example, when we see investors who enter at the peak of the market and exit at the lows, right? So they try to time the market. So these are places, for example, where an advisor can play a role. But in terms of the hard numbers, in terms of being actually able to select which funds, an AI can play a pretty important role in throwing up what are the best funds, because that is an algorithmic objective process, right? So I would suggest to every investor that you should work with a trusted partner, someone who can provide the human touch, along with a very non-biased approach to investment selection and reviewing that investment, right? So along with this person, you can plan your financial goals, you can understand, accept you can understand your risk levels, choose your investment strategy, so that human touch plus tech and AI is quite an unbeatable combination, or is going to be an unbeatable combination going forward.
Insurance strategy, is AI helping people avoid becoming the victim of insurance mis-selling also?
I don't really know if that's happening yet. Can you, I don't really think that's yet happening.
Our insurance recommendation and things on policies and suggestions are given on AI when you talk about insurance, health, term, any sort of insurance policy or coverage?
So I think the insurers would be probably a better bet to talk about. But I know that they are trying to do some things on insurance. For example, trying to provide you the right insurance when you're building a goal. So for example, I'm building a SIP, I'm investing in a SIP for my child's education. So providing an insurance at that point in time to protect my goal, right? So you have information on what the investor is trying to do or what the customer is trying to do, and then trying to match that.
Okay, Krithika, any way to figure out that we are taking the help of a right AI or the right algorithm, because there are so many and most of them are maybe in the dry run or trial mode these days because they're not completely and full-fledgedly launched in India. How do we ensure that the algorithm that we are talking to or taking suggestion recommendations from is actually worth it and knows all the aspects?
Sure. So my suggestion is, don't go for an algorithm that you've not heard of before, right? First and foremost, look for trust, right? So look for and don't go just with an algorithm. So go with someone who can help you use the algorithm, right? So if you're an initial investor who's just entering the market, for instance, you can say your needs and goals are a little simpler. You can say, I'm just using an algorithm to select the funds, right? So for example, if you ask ChatGPT, give me portfolio recommendations, it typically gives you a list of factors to consider, but says go and consult your financial advisor or go and consult someone who knows about what they're talking about. So don't just use any algorithm that is there. Don't try and use ChatGPT itself or any generative AI. It's not yet there. But rather go with a trusted advisor or a trusted partner, right? I think that's what I would say.
So far so good. Even if you get your financial portfolio designed by an AI, it's very important for you to get it cross-checked by a human financial advisor, or the least you can do is just send us your financial portfolio details to the Money Show and we will get it consulted through our expert. Thank you so much, Krithika, for being on the show and helping our viewers with this today.
Thank you.
We move on, and we at the Times Network are back with our flagship event, India Economic Conclave, which is known to set the stage for driving India's economic agenda as we move forward on the path of integrated, equitable development, which is all-inclusive, all-pervasive, universal, and one that strengthens not just the Indian economy but the global one as well. To pursue this agenda, the theme for this year is India, the emerging third superpower. IEC will feature the biggest voices from politics, global markets, economy and corporate world. So get ready to catch all the action here on Times Network. Alright, so on that note, we'll take a quick break, and post that, let's talk about the expense ratio that's going down on ETF. What does that mean for you as an investor? We'll talk to Nirav Karkera after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Some mutual fund houses have cut the expense ratio on Nifty 50 exchange traded funds or ETFs to bring down tracking error and led to higher returns for passive investors. Remember, the expense ratio is the total expense charged by the scheme. Now, let's welcome on board Nirav Karkera, Head of Research at Fisdom, and understand how will this move affect investors. Nirav, good evening. Welcome to the show. So let's break it down for the investors. What do you mean by total expense ratio in the first place?
So total expense ratio, like it almost literally suggests, it is the total expense that is charged to a fund. It is as generally termed in percentage terms as a percentage of the total assets. So that is total expense ratio.
That there's a consultation paper that's given out by SEBI, and all the stakeholders would be later on consulting SEBI on the same thing. But then let's focus on this particular news where we see that ETFs and the expense ratio on ETFs have been cut by a few AMCs. Now, what does this indicate, and what cut are we talking about in the expense ratio?
So ETFs, exchange traded funds, are basically similar to a mutual fund, but they are traded on the exchange, like the name literally suggests. And there are a few AMCs that have decided to cut the cost that is incidental to investing in ETFs furthermore. Now, ETFs, as is, have been relatively low cost products. Because most ETFs aim to replicate, especially in this context, when we are talking about the cost being cut, it is majorly in context of ETFs trying to replicate or track an underlying index, in this case, very specifically Nifty 50. So the cost attached to such Nifty 50 ETFs were, as it is, marginal. As you can see, most of the ETFs following Nifty as an underlying has an expense in the range of 5 to 7 paise, which is 0.05%, 0 to 0.07%. There are a few beyond the range, but generally it is in this range. So these are really affordable, low cost alternatives to trying to get an exposure to the performance of Nifty without shelling out a whole lot more in terms of expenses. So this is also one of the reasons why passive investing has been all the rage in recent times, because of the very low cost and the fact that this could be an alternative to certain funds that find it difficult to outperform the index. And if one were to believe that indices would continue performing, such a low cost structure would be highly beneficial to an investor.
Also explain what exactly is tracking error and how is that being considered over here?
Yeah, so tracking error, again, like with most other terminologies that we spoke about, is quite literally what it talks about. It is the error in tracking the performance of the underlying index. To simplify it, there is an index like Nifty 50, for example, and there is a Nifty 50 ETF. Now, the ETF tries to replicate the performance of the Nifty, and that is done by trying and at any given point in time having a composition that is similar to Nifty 50. Now, at this point in time, there could be certain patches where an ETF is unable to replicate the underlying index, that is Nifty 50's performance. Now, most of the deviation in performance, like for instance, if Nifty has gone up by 10%, one would quite often notice that the ETF has gone up by probably 9.9% or in the ballpark. So they aren't quite able to replicate the performance. So most of this leakage is attributable to the cost also. So while Nifty grows at a certain pace, and let's assume there is no deviation at all, and the ETF is doing its job really well and constantly replicating the performance of Nifty 50, which it should ideally, there will still be a difference in the performance, and quite often than not, typically the ETFs will slightly underperform the index. Now, this underperformance or this deviation, this difference is called as tracking error.
Investing, you can go through the index route and you can go to the ETF route. Now, because there is a cut in the expense ratio for ETFs, you think the demand or the kind of liking towards ETFs and index funds that we've seen lately, people are turning into becoming passive investors also now. At least they have started to become now. You think ETF will gain the momentum after this cut, or it doesn't matter, it's just negligible?
Yeah, so passive is the adoption of passive is on the rise, but this has more to do with the merits of passive investing and the ability of the restricted ability of certain funds to outperform the index. Obviously, a reduced cost makes it all the more lucrative for an investor. It in a way it just passes on the performance in a larger quantity back to the investor. It makes the investment a whole lot more cost efficient and effective from a performance tracking standpoint. However, the difference is so negligible considering the very small base of expense that was already there. The difference might be very negligible at first sight. For instance, we about how a couple of funds were earlier charging 0.05%, but is charging now 0.03%. So it would seem like a very minute and small change of 0.02%. But if you look at it from a cost standpoint, in absolute terms, it is a cost saving of almost 40%. If you were to convert it in rupee terms, the cost that you would incur earlier versus the cost you would incur now, and this becomes all the more prominent in case your portfolio size keeps increasing. Such a cost saving becomes highly lucrative as a proposition to investors. So yes, I wouldn't say that the difference is insignificant because that is how the percentage points would look. But if you convert it into absolute values, we are looking at a 30 to 40% decrease whenever 5 paisa or 0.05% cost structure moves to 0.03%.
But this still should not be the reason why you want to buy an ETF, right?
Absolutely not. So the ETFs are like with any other financial product, it serves a particular purpose. It has a very specific objective. In this case, it tries to replicate the index performance. Let me put it in this way. It doesn't really matter what your cost is if your post-cost performance is not really what you expect it to be. And so you can take two examples. Let's say hypothetically, there is fund A where you generate 20% returns and the cost is 10%, let's say, and you generate a post cost return of 10%. And let's say there is a fund B that generates 12% returns but has only 3% of incidental cost. You are still better off choosing the first product. So any decision based on cost alone will not really point you towards the right direction. What matters is how efficient the product is, how effectively it aims to capture the objective that it is trying to capture in the first place, and how does it strategically fit within one's portfolio. Just because something is cheap doesn't mean it is good. It needs to solve a purpose.
All right. Thank you so much, Nirav, for being on the show and helping our viewers understand all the aspect of expense ratio going down on selected passive funds. Thank you so much.
Thank you.
So we at the Times Network are back with our flagship event, India Economic Conclave, which is known to set the stage for driving India's economic agenda as we move forward on the path of integrated, equitable development, which is all-inclusive, all-pervasive, universal, and one that strengthens not just the Indian economy, but the global one as well. To pursue this agenda, the theme for this year is India, the emerging third superpower. IEC will feature the biggest voices from politics, global markets, economy and corporate world. So get ready to catch all the action here on Times Network. The Money Show with me, Kavita Thapliyal. Now, the government's decision to hike tax collected at source on international debit and credit cards has put the spotlight on foreign card spends. Remember, the use of an international credit card to make payments towards meeting expenses while overseas was so far not covered under the LRS. So, how will this hike impact your finances and what kind of impact will it have on your travel plans? Let's discuss all of this with Mohit Kabra, Group CFO, Make My Trip, and Lokendra Saini, Chief Operating Officer, East My Trip. Good evening, both of you, and welcome to the Money Show. Before I begin any question on the TCS, on international credit cards and spends, I really want to highlight this data that I was just going through in the morning. International leisure travels, has gone up 40% from June to August. That's what the data says, which is obviously 40% up, a robust recovery, but then it's still down 15 to 20% if we talk about the pre-pandemic period. So my question to you, Lokendra, here is what kind of a dip now going on with this kind of a, announcement you see coming up?
Thanks for having me on the show, Kavita. At this time, we are not seeing any difference or any change in the booking pattern for the from the holiday goers. I think the decision that has been made has been made very recently, and those who had planned their travel had already planned it, or also considering that this is also the holiday time for everyone here in India. People still would not like to risk it much. And given that there is still a bit of uncertainty around how things are going to be shaping up around this, people are continuously booking their holidays. But it'll be interesting to watch how this goes on after a couple of months from here.
You elaborate on the uncertainty that Lokendra is pointing out?
So the uncertainty which I talk about is with respect to how the payment modes are being used at the time of making payment for your international travel. Also, depending on the instrument that is being used while you're making the payment, etc., is there. Plus, we also need to understand that if somebody is using a card which is issued outside of India, however the resident is India, whether that also gets covered into this or not. So there are a few questions that we are still trying to understand whether that also gets covered into the scheme or not.
Also, Mohit, the confusion that people are actually caught up now or are tangled with is actually the LRS and the TCS. Could you explain to our viewers what's the new clarification and how should international travelers look at it going on? I mean, a lot of it has been highlighted by Lokendra, but then what do you think about this confusion? What has been your experience so far post the announcement?
Hi, Kavita. No, thanks for having me on the show. There are two separate provisions, right? And if you look at TCS provision, actually there is a tax collection at source which is mandated at 5% currently, both on tour packages as well as on overseas travel services. And whereas if you kind of look at the LRS provisions, there is this exemption of 7 lakh which is available as far as spends under the LRS remittances are concerned for overseas travel services, right? And therefore there is this little bit of a confusion on whether this limit of exemption applies when it comes to tour packages also. So I just wanted to call out these are two separate, distinct provisions, and therefore they apply separately as such. What used to happen was earlier, like you mentioned, international credit cards were kind of exempt from LRS provisions, and they have not been brought under the LRS provisions as well. So now across international credit cards or debit cards, the TCS levy will be applicable, and the 7 lakh limit, as clarified by the government, will be applicable.
Right. Also, I just wanted to understand what is the kind of percentage of revenue that you get from tour packages? I mean, first, if I want to ask this to you, Mohit.
See, tour packages, particularly international tour packages, had been growing. But since the 5% TCS had been introduced about a few years back, we have seen a steady decline in the mix of package bookings. So earlier, probably we used to see same value of bookings being done across the year for international as well as for domestic packages. Currently, it has shifted very significantly in favor of domestic packages. The reason being, if you see in the manner that TCS is levied currently, all kinds of tour packages have to undergo a TCS levy of 5%, whereas travel services, to the extent they are below the 7 lakh limit, they do not kind of undergo a TCS levy, and therefore the customer sees an incremental 5% payout, and that has kind of led to a little bit of a shift in booking preference, particularly on overseas tour packages. What we're concerned is if this kind of rate goes up from 5% to 20%, that could be a very sizable kind of a difference that would come up and could lead to kind of very significant decline in tour package bookings for overseas travel.
Indra, your experience on tour packages, is it the same as Mohit elaborated and spoke about?
Yes, Kavita, this is more or less the same. We've not seen much of a difference in terms of our international packages, even with the inclusion of 5%, because coincidentally, this time also collided with the recovery travel, which people call it rebel travel and all. People have been looking out ways to experiment with new places, going out international more as compared to previously. So I think overall that number does not show any kind of implication that is created because of 5%. But I will 100% agree with what Mohit is saying with respect to the 20% change, because that is a very, very, sizable amount, which results into somebody can easily shift from a, long distance international travel to a short distance, or somebody just moving from a international immediately to a domestic. So that will have a sizable impact, definitely. And this will also have a big impact in terms of how travel companies have been planning to create a more experiential kind of a holiday destination and all of those places. Because we see that with the change in infrastructure and all, there has been, a lot of new places which have come up. So that might get impacted a bit as we go after next 2 months.
Mohit, what about seeing rise in other payments, form of payments and other informal channels? Do you think this can lead to that?
It could. It could. Like if you see, practically all digital payments or online payments will kind of, get covered under the TCS. So it's only, the non-digital payments that kind of, it could increase the preference for the customer to kind of, look for those options, because the quantum involved is pretty significant now at 20%. That's another concern, and see that kind of pretty much goes against the adoption of digital kind of payments that has been the focus of this government. I think the broader point is twofold. One, if you really look at it, the whole intent of levying TCS, as the government has called out, is not to levy it on small transactions, and more importantly, levy it from a perspective that where the disclosed income is kind of way below the nature of expenses being incurred, that the government wants to come in with a TCS provision. Ideally speaking, if you look at it, domestic cards or UPI payments, which do not have forex kind of payments enabled on them, usually see small value transactions. And also, if you see from a customer's point of view, he's making an INR payment or a rupee payment and not necessarily kind of making a forex kind of a booking. And therefore, the demand for the domestic travel or tour, agents industry has been that we should keep these INR payments, out of the ambit, and payments out of these domestic cards or UPI out of the ambit. International credit cards, debit cards could kind of continue to see this TCS levy, because these cards are forex enabled on them, and they also kind of typically have much larger limits, and higher value transactions happen typically on international credit cards and debit cards. So that's been one kind of an ask. And the second one is there should not be a differentiation between tour packages and booking of travel services on an individual basis. So if you book 3 separate hotels individually versus you kind of take a package from a tour agent, so long as you're kind of selling out or kind of paying similar amounts, and these are smaller values, why should kind of individual travel services be getting an exemption limit, while the tour packages kind of don't see any exemption at all, and get and TCS is levied irrespective of the value involved. So those are probably the two key asks for the travel industry, just to make sure that the domestic travel industry remains competitive and customer inconvenience is resolved, while the intent of the government is still taken care of.
Are you in line with these asks?
Yes, we have been calling out these asks rapidly.
Yeah, Lokendra, are you
Yes.
in line? Yeah.
Yes, no, absolutely. I think this is important, that how do we standardize things, right? Because there has to be parity in terms of understanding from a traveler standpoint also. See, looking at India, we are evolving as a nation in terms of those who are picking up international travel also as a leisure option when they look to take their families out. Now, when you bring so many conditions and implications between when you do a package or when you don't do a package, those in itself create a lot of filtrations in the mind of the end user. Whether should they pick up a package or should they just book it separately, and how do they go about it? And also, as we understand that a lot of market in India is still operated through a travel agent network, they will also try and recommend things in a way which will be little light on the pocket of the customer. And also that would not be the right way how we want to see a more organized and a more sorted way of a travel happening. So that obviously is a concern. I think one more thing that I want to highlight is that, like the way automation is happening across all multiple industries and categories, whether you talk about health tech, fintech, or anything else, as an online travel companies, both of us, we would like to create a self-booking behavior for the end user. And that's where, packages become extremely important, because everything that a customer is looking out for their travel, while, either traveling alone or with family, this is all combined all together to ensure that there is no inconvenience for them at the end of the day. Now, if that has an implication in terms of costing, now that would definitely be taking a backseat. And because of that, this whole ecosystem will again remain, more or less fragmented, which is what is not ideal for a, high scale growth for any category.
But then, how much of it do you think you will put trust on innovating and maybe customer education also on the part where you can claim your TCS? Mohit, anything on those lines you think can actually beef up your confusion or the concern that a customer might have?
No, of course, that's an ongoing journey, right? We've been kind of calling this out since the time the 5% TCS was levied, that this is not a cost implication, it is more a cash flow implication. But what we need to kind of keep in mind, Kavita, over here is a lot of the people who are kind of first-time travelers, or say traveling to say Southeast Asia, Middle East, uh, these locations are not very expensive. The budget outlay on some of these locations is almost similar to what the budget outlay is on a domestic holiday, and therefore, for them having to fork out a significant amount additionally, even if it is a cash flow issue, becomes a little bit of a bottleneck. And particularly when you look at leisure travel, where the family travels together, the amount gets compounded. The other part is, in case you do not really have an ability to offset this credit, in terms of advance payments, because most people are salaried employed and therefore, do not necessarily pay advance tax, then the credit for this amount, which is unutilized, could only come back once the returns are finalized and the refunds are kind of initiated, from the tax department. So it could take a long period, and people would not be very open to kind of waiting for an year and a half, just to get these amounts back in their cash flow.
Lokendra, your take on it? Is there more trust on innovating and creating customer awareness on this?
Yes, we are already doing that. We are educating customers who are reaching out to us to inform them beforehand, before they make a final plan. Because early days when we were not so proactive in terms of telling them, we definitely saw a sudden dip from the time a customer more or less agrees to go for it, and then there is a 20% part or component around TCS gets introduced. So that is something we've been doing. But I think, again, coming back to that point, which is more important, is that, how do we kind of standardize this, is what I would like to reinstate on. And I want to feel that, can there be something which can be made a little bit more, in the interest of a taxpayer, right? Like Mohit also mentioned, because this 1 year cycle is one very big. Two, this money is important, right? I mean, any money that one saves for a holiday travel is a money that they save from their savings, and anything on top of it, something that they have to hold it, is going to be a big demotivation. So if there is some way this can be, either made a little bit more flexible in terms of claiming it or adjusting it in some other expenses, and against some other losses, maybe securities or something, I think it could still be a good way to still fight this battle.
Sure, we'll have to keep an eye and track this issue as to how this rolls out. But in the meantime, thank you so much, both of you, for being on the show and helping our viewers with a complete understanding of this issue. Thank you. We move on in the last leg of the show, where we take your queries and have it answered through our experts. And today I have Amol Joshi, Plan Rupee Investment Services. Amol, good evening and welcome to the show. I have our first viewer online who wants to ask you the question, Amit Kumar Nigam from Delhi. Hi Amit, good evening. How are you doing?
Yeah, hi, Kavita. This is very fine. Thank you for taking my query on the live show.
Thank you so much for sending us your query. Okay, so I believe it's on a latest issue, impact of TER on mutual fund return. Is that what you want to ask?
I want to add just only one thing. Is the latest recommendation of SEBI of TER. What will the impact? What will be the impact on the mutual fund returns and the AUM of the? And do we have to check actual AUM of the mutual fund before investing? As the new norms are coming?
Sure. Okay, we'll get that answered. We'll understand the current scenario, and also if few of these proposals get actually formalized, what will be the outcome on your mutual fund return. Thank you so much. And Amol, over to you. What's the existing pattern of TER?
First, understand what TER is. TER is total expense ratio. This is the kind of expense that schemes or fund management companies are allowed to charge to run your mutual fund scheme, to manage your mutual fund scheme. Now, broadly, there are multiple categories of mutual funds, but broadly, you can divide them between 2 or 3 categories: pure equity funds, pure debt funds, hybrid funds, and so on and so forth. As of now, equity funds have a TER cap of 2.25%. Now, coming to the question, what will be the impact of TER? The impact will be very simple. All the measures taken by market regulator SEBI, mutual fund regulator SEBI, have been investor facing. In the sense, there has already been a downward revision of TER sometime in April 2020. And going by the look and feel and the language of current draft proposals, it looks like that the TER will be further rationalized. To answer it in one line, if the TER gets rationalized, if the TER gets lower, the customer benefits because it boosts the returns of the schemes to that extent. That's point number one. And I think Amit also asked the second question, what will be the impact on AUM? Now, if the returns go up, if the cost of investing into a mutual fund goes down, consequently returns go up, then I would say that there would be more and more flows coming into the industry. So the impact on AUM will also be positive. In other words, AUM is likely to go up as the new regulations take shape the way we are looking at them.
All right, Amit, is that clear? Do you want to ask anything else?
Yeah, that's sufficient question actually. Thank you so much, ma'am.
Thank you so much, Amit. And we move on, and let's move on to our email query, which is from Raila. And I think, Amit, you have that question. Amol, you have that question on you. Raila says that she is new to mutual funds and she wants to choose index funds over small cap or mid cap. She wants to ask if she wants to know if that's the right strategy for her. And she also says that she has a higher risk appetite. Now, that's a very interesting question because when we talk about passive investment, we just covered a discussion where the passive ETFs have cut down, specific passive ETFs have cut down their expense ratio. So maybe you can touch upon that point also in your explanation, Amol. But then, yeah, if Raila has a higher risk appetite, shouldn't she be going the active route?
All right. So if Raila has a higher risk appetite, the rule of thumb says that she can probably look at or she can opt for mid-cap and small-cap funds. And mid-cap and small-cap funds over a long period of time, it has been seen that these funds are able to beat their respective benchmarks. So you're right, Kavita, here that she can probably look at actively manage mid-cap and small-cap funds. But that is only one part. Raila also mentioned that she's a beginner and her question was framed in such a way whether I should look at index funds or I should look at mid and small cap funds. Now, these two are not directly apple to apple comparison. Let me tell you that there are also index funds in mid cap and small cap category too. In the sense, you do not have the binary choice of whether index funds or small cap, mid cap. Within mid and small caps also, you can opt for index funds. So I would say as a beginner, you're probably your best bet is to probably go with Nifty index fund. And as your expertise, as your understanding of the investment instruments and your own risk appetite, if you are a beginner, I hope when you conclude or when you communicate to us that you have a higher risk appetite, I hope you have done the proper exercise of assessment of your risk appetite. If not, then as your understanding and risk appetite truly grows and as you gain the market experience, later on you can always opt for mid and small cap funds. But to start with, as a beginner, your best bet is the Nifty index fund. That could be your choice, Raila.
But then going forward, if she wants to diversify her portfolio, what should be the exposure, maybe in a large cap, mid cap, or small cap? Because I don't know how old is Raila, and although she's mentioned that she's got a higher risk appetite, it should not be the case where she lands up investing a lot in a small cap and a mid cap category, which usually people land up doing, because they want higher returns and quick returns. That's what they think.
Right. This is a very important dimension that you have brought out, Kavita. Now let's also look at the other parameters. Like when you say higher risk appetite, choosing equity asset class itself, you are going towards a product that has a higher risk involved in it. If I just take you back in time 2 or 3 years, during the COVID crash of March 2020, the mainstream indices, that is Nifty and Sensex, over a few weeks saw a crash of about 35%. So that is a significant drawdown for any person, no matter what your risk appetite is. So choosing equity itself, you are probably fulfilling a large part of your higher risk appetite and ultimately, wanting to gain higher returns out of it. Coming to the crux of the question, what is the kind of mid and small cap exposures you should have? Since some of the aspects like investment horizon, age are missing, let me give you again a rule of thumb kind of an answer. I would say a multi-cap, large cap, flexi cap exposure together, or in other words, large cap exposure together should be about 60%, and about 35 to 40% can be into a mid and small cap. Within that also, small cap should be comparatively lesser. If you say 40% is your total exposure to mid and small caps, I would like to place mid cap exposure at about 20-25% and probably 15% into small cap. So 60-40, and within 40, 25-15 is the way to go.
Right, that's the suggestion coming up for Raila. And on that note, thank you so much, Amol, for being on the show and helping our viewers with their financial portfolio. And time to sign off, but then I'm going to leave you with our WhatsApp number and email ID where we are expecting your questions that will be answered by our experts. Thank you so much for watching. Goodbye.